welcome back to Political Misfits on Radio Sputnik, where we bring you news, politics, and culture without the red and blue treatment. I'm John Kiriakou. President Biden this week enlisted a dozen Asian countries to join a new loosely defined economic bloc meant to counter China's dominance and to reassert American influence in the region 5 years after Donald Trump withdrew the U.S. from a sweeping accord that it had negotiated itself, the TPP. Biden did this despite liberal opposition at home. Meanwhile, the U.S. economy is slowing, inflation is soaring, interest rates are up, and the country is approaching the midterm elections. What issue is more important right now than the economy? We're joined by Steve Grumbine. He's founder and CEO of the nonprofits Real Progressives and Real Progress in Action, and host of the podcast Macro and Cheese. He's also a leading activist and evangelist for modern monetary theory. Welcome back, Steve.
Hey, thank you so much for having me on.
Oh, really happy to have you, Steve. And I've got so many questions for you. Before I get to interest rates and domestic economic issues, I want to ask you about this new Indo-Pacific agreement. It looks like the TPP. It smells like the TPP. What are your thoughts? Good, bad, or indifferent? Is this essentially the TPP?
Yeah, you know, it's terrible on so many levels. As a person on the left, I recognize this is once again, you know, the U.S. putting interests in place to try to ensure that it has access to low-cost goods, low-cost production, et cetera. Since we've gone and screwed the pooch with our Russia position, we now have to kind of, you know, calcify ourselves, kind of lock ourselves in with someone. Someone's got to be our business partners, right?
Yeah, right.
And so this is our attempt to maintain that lavishness that we have done on the backs of third world nations. And I don't know all the details, so I don't want to overstate and overplay my hand here. But suffice it to say, free trade is far from free usually.
There is so much focus today on rising interest rates and what it means for the economy and for the midterms this fall. Our understanding of interest rates is that rising rates are generally a bad thing because it increases the cost of doing business and it increases the cost of consumers' purchases. The thing I'm curious about is understanding more about modern monetary theory and how the theory explains the effect of higher interest rates and the federal debt. Am I right to say that in MMT, rising interest rates are not necessarily a bad thing?
No, not at all. In fact, you would speak to the average MMT developer, including Warren Mosler, Randall Wray, Bill Mitchell, and Stephanie Kelton. They would be advocating for a permanent zero interest rate policy or a low to no interest rate policy. The idea of having higher interest rates, you need to understand the interest payments are on reserves, and this is so hard to do in like 2 seconds or less. But just suffice it to say, the banking system has these thing called reserves, and they're used to clear payments in the banking system from one institution to another. So you write a check, they go ahead and clear it through the other bank, and there's these things called reserves that float back and forth between the two banks. And what happens is that when Bank A needs to acquire reserves to handle that transaction, they have to pay a certain price for reserves. Well, it previously had been zero. Right. We had kept a zero interest rate policy, and so payments just cleared. Now, all of a sudden, that they're now paying it for what is formerly a very secure transaction. Now they're adding interest to that, and that starts matriculating through the economy as a basic income for people who already have money. So this is one of those the rich get richer things. So there's nothing about this that in any way, shape, or form an MMTer would say, oh, yeah, that's a great idea. Definitely, let's raise some interest rates. It'll be great for all. No one on the MMT side that I know of, that I speak to, would ever advocate for something like that.
Tell me a little about the federal debt. Here's what I have written here. An MMT economist recently explained that rising interest rates are actually helping to reduce the federal debt. Not the deficit, but the debt. For example, the American Rescue Plan was financed at last year's rates that were at record lows. Yet today, the U.S. Treasury is collecting at a higher interest rate. So the basic math is that the Fed was borrowing at 0.5% and is now collecting almost 3%. Is that right? Does that make sense to you?
Well, let me ask you a question. Who does the Fed borrow from?
Well, that's
it creates
a good
money.
question.
So who does it borrow it from?
Yeah.
It doesn't. It doesn't borrow. It's a word that has no meaning.
Right.
And so we spend first.
Right.
And then we tax a little bit back. That's the game. It's spend first, tax back. We don't tax to find money to spend, and when we don't have money, we borrow from some nefarious Chinese. Hey, can we borrow some U.S. dollars, China? I know we're in a kind of an economic war here, but we'd still like to borrow some U.S. dollars from you, China. It's just saying it. It's almost
ridiculous.
You start laughing after a second, right?
Right.
So the national debt is nothing more. This is one of those ones where you definitely want to break out your pencil. The national debt is nothing more than the sum total of every untaxed dollar in the economy since the dawn of time. So that includes treasuries and securities and all these other things, because they're just another form of money. It's like a savings account at the Fed. So if you think about it, it's interest that has been pre-funded. They know we're going to sell this bond for 6 months. It's a $10,000 bond. We're charging it for this much. We've already factored in the interest payments because it's not fluctuating. It's a specific amount for a specific bond that they purchased. So this is just a way of adding money into the economy, but it's adding it directly into the wealthiest of all people. Okay. Mm-hmm. Now, if you think about it like that, the MMT perspective would always be to come back and say interest rates are a way of literally staving off inflation and things like that. At least that's what it says on paper. But if you don't have to defend a positive interest rate, you don't have to pay interest payments on it. Get rid of the damn thing. Stop selling bonds. They don't actually finance the government. It's really a way for the rich to keep their money, to have enough money to keep it going, to keep growing their base as inflation kicks up or whatever. They can capitalize on that by getting more money through interest hikes. And so this is all smoke and mirrors, led to believe the average person just goes, yeah, oh my God, we got to do this. But in reality, it's not helping at all. It's like putting leeches on you to try and solve some fever or something. It's ridiculous.
You know, you've anticipated.
No MMTer would say that.
You've anticipated my next question, which is that we hear so much in the mainstream media, especially in places like the Wall Street Journal and the Financial Times, about how the U.S. and Chinese economies are interwoven because the Chinese own so much in American government bonds, right? It's over $1 trillion. So my question then to you is, does that matter at all? Or does it matter politically?
No, think about this.
Go ahead.
No. So imagine this, right? As long as we're doing business with another country, when that country sells goods and services to us, they receive U.S. dollars for their payment. Mm-hmm. So they're sitting there. Let's say China does a lot of manufacturing for the world, which it does. And the U.S. buys a lot of Chinese products, which it does. Mm-hmm. The Chinese are sitting there with a basket full of earnings that they have done legally. They've bought a bunch, they've sold a bunch of stuff to us, and now they're sitting there with a bunch of U.S. dollars, and they say, what do we do with all these U.S. dollars? So, I don't know. I guess we could trade some of it off in the foreign exchange market and get it back in yuan. Maybe we could save in another currency. Maybe we'll trade. But we're going to keep doing business with the U.S., so rather than do that, why don't we go ahead and earn a nominal interest on our already existing U.S. dollar holdings that we just made through purchases, and we'll go ahead and save them there at the Fed, or earn whatever that 1%, 2%, 3% interest is on bonds. And for regular people, it's not a lot of money. It's kind of like a weak bet, but when you're putting $1 trillion out there at 3%, that's a lot.
Yeah, it's a lot.
And so they say, hey, it's a safe bet. Nothing's safer than a U.S. bond. And they go, so we don't actually borrow their money. What bonds, if you go back to World War II, okay, World War II, the factories were at 100% capacity. People there was no cars to buy. There were no refrigerators. It was just the total economy had been put to the war machine. So, but people were working round the clock, earning a lot of money. So what are they going to do with all that money that they've earned? And there's nothing for sale to purchase that is for domestics. The domestic economy had dried up because of this. So what they did was, recognizing they didn't want to set off a spiraling inflation, they went ahead and started selling war bonds. The government was already funding the war. They didn't need your money. You weren't paying for that.
Right.
So what did they do? They used that to take money and delay purchasing power. Okay, over 5 years, you'll get so much interest back. Oh, it sounds like a good investment. Let me buy some war bonds. Well, during this time period, people were not spending a bunch of money because they were all buying war bonds. Okay, it's the same thing with China. You're trying to defend a positive interest rate. China buys these bonds and so forth. It's supposed to delay some sort of purchasing power, but ultimately it's also simply a basic income for the rich. I mean, these guys already have money. You have interest rate hikes. What happens? They get more money. So, just keep in mind the national debt is nothing to worry about. It's the sum total of dollars in the economy. Mm-hmm. You cut the debt, you reduce the money in our economy. That means you're in my pockets. So it's very important to remember that the actual debt isn't really owed to anyone. These people have bought savings bonds, just like you would buy a savings bond or a CD or whatever other thing you might buy to pick up some spare change in 3 years. You want to have a safe investment for your kids' student loans or whatever. Maybe you buy some bonds. It's the same thing with China. They just have all these U.S. dollars there that they don't really spend well in China. So let's go ahead and keep them in the Fed and let's earn a nominal interest rate.
More than 50% of households, Steve, are invested in the financial markets through retirement plans, IRAs, 401ks. So when we talk about the stock market not being a reality for most people, the truth is that we're all affected, or most of us are affected by this recent bear market. The S&P dipped into bear market territory on Friday. There's a decline in the wealth effect as stock values slide. What can people do to protect themselves?
I'm not a stock guy. I'm really not. I will tell you that, my expertise is not in microeconomics in terms of giving investment advice.
Sure.
But, I would say that, a bond has a set yield. You know what the interest is. If you're looking to save something, go into very, very safe investments that have very low volatility during this bear slide. I would pick bonds. I would buy a bond that has, 2-3% and know that I'm going to get that 2-3% at the end. That would be how I would approach it. If I was looking for a safe bet, that would be what I would do.
Yeah.
But I'm not an investment guy, so don't take anything I say. That's definitely not my expertise.
No problem. During the pandemic, many people took early retirement, and now many may be reconsidering this as they don't feel so wealthy after all. This has been in all the mainstream outlets. We've seen it at CNN and the Washington Post, the Times, Barron's, the Journal, everywhere. The Fed is raising interest rates to slow down the economy. The stock market, people look at the stock market to sort of do the work to protect them, to hedge against inflation. What's your view on how the Fed is handling interest rates right now? Are you worried that they may overdo the rate hikes and maybe further exacerbate a recession?
Absolutely. In fact, I think all indicators are there. If you listen to the folks speaking from the Fed, including Jerome Powell, all of them are hearkening back to Volker times.
Yes.
And Paul Volker famously destroyed the economy to save the economy.
Yes.
And you can just hear the oxymoron there, right? I mean, this guy is the worst neoliberal, one of them up there with Hayek and Friedman. Yeah. Horrible, evil bastard that really, really killed a lot of people, should never be celebrated and should only be defecated on. I mean, this guy really, truly set the stage for awful things to come. And Jerome Powell he worships at the altar of Paul Volker. So I think it's very important to realize that this is a monetarist extension, a libertarian belief system. This is the worst possible approach to doing all of this stuff. And it is going to create a lot of pain and suffering as they hike those rates up. I just spoke to Randall Ray, who's an economist, MMT economist, the other day, and there's some differences of opinion with him and Warren Mosler on this. But one of the things that he said straight up was that, in order for interest rates to ever have the kind of slowing of the economy that they want, they would need to jack rates up so high that people simply didn't go get credit anymore. They just simply didn't do it. But the truth is that they've shown that high interest rates don't really stop people from buying.
No, that's true.
In fact, the areas, if you look at the economy for inflation, are not really about borrowing. I mean, you don't borrow to go to dinner usually. Most people don't borrow to go to the movie theater or whatever. It's the entertainment. It's that kind of, out there social stuff that people are spending money on. There's just not enough people working in it. There's not enough whatever goods and services out there for it. And so the prices are going up there, right? But so raising interest rates, what is that actually impacting?
Right.
I mean, what are you talking about? What kind of loans that you're taking money out for would have anything to do with it? It's attacking the wrong problem. It's attacking a supply issue with supply chains with a monetary operation, and the two are not related in any way, shape, or form. The only difference is there'll be a lot of pain for people.
Yeah.
And, they're happy about that because you've seen every time there's a downturn in the economy, the rich buy things pennies on the dollar.
Yes.
As people go bankrupt and lose everything, they retrench and then start the cycle all over again.
Yes.
If you go to the arcade and you see that game where you drop a quarter in the thing and it's got that ledge that keeps pushing the money off of the thing, a couple layers, that's what it's like every time you drop that coin down, and all of a sudden it totally changes the environment each time. And this is what they do. Each time they retrench, and you see that machine go and just crush us all.
Yep.
That's my fear. That is my fear, is that we have three ways of getting money into the economy. One is federal spending. Well, we cut the spigot off on federal spending.
Sure.
Two is being a net a net exporter. Well, we're clearly not a net exporter.
That's not going to happen.
So that leaves us with one other area, and that's private debt, which now all of a sudden they're going to jack the price of debt up because guess what happened during the pandemic? People paid off their debt. There were people that were paying down credit cards during that time period when they weren't out there running on the roads and stuff. They had a little bit of money. They paid off debt. So what the government is seeing is, hey, in our three sectors, there's private debt available for us to blow up again.
Yeah.
So they're going to put the onus on us to go into debt to keep the economy going. And that's what I'm seeing. That's what I'm seeing.
Okay, we'll leave it there. That was the voice of Steve Grumbine. Steve is the founder and CEO of the nonprofits Real Progressives and Real Progress in Action, and he's host of the podcast Macro and Cheese. He's also a leading activist and evangelist for modern monetary theory. You're listening to Political Misfits. Stay tuned. One last break, and then we're going to come back with some closing thoughts.